We have 5 U.S. narrow moat stocks that are set to cause some commotion on the charts. Hold on to your seatbelts, folks. This is going to be a good one. The U.S. market is the strongest in the world, and as such, it is not one you should ever ignore. In fact, there is a lot of money waiting to be made in the U.S. markets, and a lot of amazing companies that you may not even be aware of. The companies we are going to look at today are some awesome narrow moat selections with good fundamentals, and they are set to do very well as we transition into a bull market. These are companies that are more than worthy of gracing your watch list for sure. Of course, looking at narrow moat means we are not looking at those huge blue chip US companies. There is no Magnificent Seven on today's list, or those other US companies that are household names. These are the smaller, packed full of potential companies that may very well slink under many an investor's radar. Join today's conversation. Let me know in the comments if you have any US underdog stocks. Thank you, of course, for your participation. If you love this sort of content, be sure to subscribe for more. And another huge thank you for that click. For qualifying the stocks I selected for this list today, I used the following criteria. First, I was only looking at stocks on the New York Stock Exchange with market caps of at least $1 billion. They needed to have positive return on equity, a 3-year annual growth rate above 10%, and I also wanted a dividend yield of at least 2%. In addition to all of that, I was looking for a debt-to-equity ratio below 50%. I was able to make the qualifiers a little more stringent this time around, as the US market is, well, it's not short of narrow moat stocks, that's for sure. Today's list is sorted by their 1-year total return. Anyway, without any further ado, let's do this. Kicking off this list, we have Watsco Incorporated with a ticker of WSO. They are based out of Miami, Florida, and they are engaged in the distribution of air conditioning, heating, and refrigeration equipment, as well as related supplies and parts. Their current price comes in at $395.50, and they've got a market cap of $15.56 billion. Their beta comes in at 0.87, so they are a little less volatile than the market average. We have for earnings per share 15.15. We have a price to earnings ratio of 26.10. When it comes to their return on equity, that comes in at a very nice looking 28.17%. Let's take a look at their debt. Their debt to equity ratio, very nice at 18.34%. When we switch to their dividends, they do have a yield of 2.478%. It is a quarterly dividend of $2.45 USD per share. The payout ratio on that comes in at 63.04%, so it is definitely sustainable. Looking at their returns, on the 3-year return on investment, that comes in at 58.61%. Factor in the dividends, we get a total return of 69.29%. When we move to the 1-year, the return on investment, it comes in at 30.70%. Adding in those dividends, we get a total return of 33.93%. They do hold a leading position in the HVAC distribution market, and with their fundamentals, they may very well keep venting out those profits for time to come. Coming in at number 4, we have Radian Group Incorporated with a ticker of RDN. They are based out of Wayne, Pennsylvania, and they are a provider of mortgage insurance, risk management products, and real estate services to financial institutions. Their current price comes in at $29.11, and they've got a market cap of $4.46 billion. When it comes to beta, they have a very average looking 1.06. Their earnings per share comes in at 3.87, and they have a price to earnings ratio of 7.52. That return on equity comes in at 16.23%, and when we look at their debt to equity ratio, that comes in at 40.95%. Switching over to dividends, they have a yield of 3.092%. It is a quarterly dividend of 22.5 cents USD per share. Their payout ratio, once again, pretty sustainable at 22.61%. Looking at their returns, on the 3-year, their return on investment comes in at 40.56%. Factor in the dividends, we get a total return of 50.80%. Switching to the 1-year, their return on investment comes in at 30.83%. Add in the dividends, we get a total return of 34.88%. RDN does have a very solid position within the mortgage insurance industry, and this is an industry that, of course, is going to benefit as those US rates start to come down, maybe as early as May. Taking our 3rd spot, we have MGIC Investment Corporation with a ticker of MTG. They are based out of Milwaukee, Wisconsin, and they specialize in providing mortgage insurance, other mortgage credit risk management solutions, and ancillary services as well. Their current price at the time of recording came in at $19.81. They have a market cap of $5.36 billion, and they've got a beta just above the average at 1.28. Their earnings per share, that comes in at 2.49, and they have a price to earnings ratio of 7.96. When it comes to that return on equity, that comes in at 15.33%, and their debt to equity ratio, nice and low at 12.68%. I like to see low numbers for that, that's for sure. When it comes to their dividends, they have a yield of 2.322%. It is a quarterly dividend of 11.5 cents USD per share. That payout ratio, pretty darn low at 17.27%. You can already see there is a pattern of sustainability in the dividends in today's list, and that's going to continue. Looking at their returns, on the 3-year, their return on investment comes in at 59.63%. Factor in the dividends, we get a total return of 68.25%. When we look at their 1-year return on investment, that comes in at 44.60%. After the dividends, we get 47.74%. That's not too shabby. With an expanding housing market in the US, this is a company that is positioned well to get a fair share of those sector profits. In our almost top spot at number 2, we have the National Healthcare Corporation with a ticker of NHC. They are based out of Murfreesboro, Tennessee, and they provide a wide range of healthcare services. They specialize in nursing facilities, assisted living facilities, independent living facilities, and home care programs. Their current price comes in at $92.38. They've got a market cap of $1.42 billion. They have very low volatility with a beta of 0.36. That earnings per share, that comes in at 2.91, and they have a price to earnings ratio of 31.75. Their return on equity, one of the lower ones in the list today, it comes in at 4.85%. When we look at their debt to equity ratio, that's also pretty low, and this is one of the lows I do like, the 11.45%. Looking at their dividends, that yield comes in at 2.555%. It's a quarterly dividend of 59 cents USD per share. Their payout ratio, one of the higher ones on the list today, 79.73%, but it is still sustainable, so that's not an issue. On their returns, their 3-year return on investment comes in at 9.70%. Factor in the dividends, we get a total return of 17.63%. This is a company that did suffer a little bit in the bear market, but they are recovering very well. So when we do look at that 1-year return on investment, we get 56.39%. Adding in the dividends, it gives us a total return of 60.35%. They have a very comprehensive range of healthcare services and a track record that sets them up very nicely for some long-term growth and stability. Also, keep in mind that unlike Canada, the US healthcare system is a for-profit system. In our top spot at number 1, we have MDC Holdings Incorporated with a ticker of MDC. They are based out of Denver, Colorado, and they are engaged in the home building and financial services industry. In a nutshell, they purchase finished lots or develop lots that will be used for the construction of single-family detached homes. They also provide mortgage financing to those home buyers, so it's almost like an all-in-one. Their current price comes in at $62.74. They have a market cap of $4.68 billion. They are a little more volatile than the market average, with a beta coming in at 1.57. Their earnings per share come in at 5.29, and they have a price to earnings ratio of 11.85. Their return on equity, that comes in at 12.40%, and they have a debt to equity ratio of 50.96%. Jumping down to the dividends, they have a yield of 3.507%. It is a quarterly dividend of 55 cents USD per share. Their payout ratio, nice looking 39.70%. When it comes to returns, on the 3-year return on investment, that comes in at 4.46%. Factor in the dividends, we get a total return of 13.87%. This is another company that did struggle a little bit in the bear market, but wow, have they recovered. On their 1-year return on investment, that comes in at 62.50%. Factor in the dividends, we get a total return of 67.81%. Holy banana bread, that's not too shabby. This is a company prime for solid expansion into more territory, and hopefully that leads to an expansion in, well, their profits as well. These are some pretty good narrow moat US stocks, and I will be very excited to see how they do over the next year. There is so much potential right now in the US market as a whole. If you are interested in any of these stocks we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on the previous Canadian narrow moat stocks. I will see you in that or the next video.